Today we discuss how simple or complex you should make your portfolio, and if index-linked annuities are all they're cracked up to be.
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our June 4th, 2024 edition of InvestTalk. I'm Justin Klein, and the objective here is the same as it is every day, and that is to help you become a better investor. We do this by bringing topics to the table that we think are relevant and important to discuss about either today's market environment, economic environment, or just a lesson that you can take away to your own personal situation so that you can make better decisions, so you can capitalize on the opportunities and you can avoid the pitfalls. And there are many of each at any given time. And so you need to have your head in a swivel and be prepared so that you continually make positive steps forward. You don't have big steps backwards. And that's what this is about. It's not one giant step forward you're going to make in any particular day. You might make that in a year's time, but no single day is going to get you where you want to go. It's about one step at a time towards the right direction. And that direction is towards financial freedom. And that's what this show is really about, is helping you get there. And with that said, we will talk about the market performance for today and run down some show topics, but right after we tackle our first caller question now.
Hey, Steve and Luke, longtime listener, and condolences to Steve and his family. Had a question for you regarding index-linked variable annuities. My understanding is that you receive a index performance with a downside buffer with an uncapped potential for gains and some sort of participation rate on top of that performance. Wondering if there's a catch. Seems like it's too good to be true. Is there anything I'm missing? Thanks. Bye.
Yeah, you are missing the fees. And it's something that Steve always talked about. And that was that you are you're paying for the index. Yes, you're linked to an index, but there are still fees taken out. Okay, so don't think that it's one for one, dollar for dollar. The SP was up 18% that year, and you're getting 18%. No, there are fees that you do have to pay, and that is something that most of the the broker is not going to tell you. Okay, and on top of that, you are giving up liquidity. There is a surrender period, usually between 5 and 10 years. And that's because the insurance company is trying to make back the commission that it paid the salesperson. Okay. So yes, annuities. I have never had anybody that I know, client, non-client, that I've talked to that was happy that they bought an indexed annuity, a variable annuity, a universal life policy, a whole life policy. Years in, they're always either ambivalent, it's okay, or not happy with it. Nobody's ecstatic with it. Nobody. 0% of people that I've talked to have been ecstatic that they bought an indexed annuity, a variable annuity, once again, a whole life or universal life policy. So the results kind of speak for themselves. It's all marketing, and they don't tell you they don't discuss the fine print, and there's a lot of fine print because, as Steve always said, these are big contracts, and they tell you the big top line pros, but they don't discuss the bottom line cons. Annuities are for one thing and one thing only, and that is to buy a fixed annuity for a certain small subset of people that's trying to guarantee themselves an income stream in retirement. Maybe they're trying to supplement their Social Security so that they cover all their basic expenses. And then from there, it's kind of the rest of their money might grow, and they want to have that security there, right? And everything else is more of a plus. So for some people, at or near retirement, that can work. But very few people should ever buy an indexed annuity. Thanks for the call. Now, we have a lot of ground to cover over the next 45 minutes, and our main focus point is about how simple your portfolio should be. Should you make it a bit more complicated? And what are the pros and cons of that? Less can be more, but also less can be too little as well. There are exceptions. So we're going to talk about portfolio construction in retirement and leading up to retirement as well. And we also have other topics on the docket. One is in regards to the consumer. Is the consumer finally slowing? And by how much? Okay, we're going to look at that. Also, baby boomers, they have a ton of wealth, but they are stingy with that wealth. And what does that mean for the broader economy? And then lastly, if we have time, private equity. They've been buying up doctors' offices, and that has been driving healthcare inflation. So we're going to look at that practice as well and whether that will continue. Okay. So that's on the docket for us, including your voice bank questions. One is on Rio Tinto and the other is on Sprouts Farmers Market. And I also have some questions that came in via the comments section over on the InvestTalk YouTube channel. And of course, I welcome your finance and investment questions right now on 888-99-CHART. Now we're heading into a short break. On the other side, I'll talk about today's market activity. But remember, you can call anytime and leave your voice bank question at 888-99-CHART. Hey, InvestTalk community. Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast. $88.99 chart, 888-992-4278 is how you get through and ask your question on today's show. And today we had a decidedly down day. It was mainly down in the commodity sector. And you had energy down, you had materials down after a big run. Now, a lot of this is mainly just consolidation, so it's not really breaking any major trends. But oil did hit its lowest level of the year in the low 70s. So, but the energy stocks did recover kind of to the highs of the day by the end of the day, still down decently. So that's where the concentration of the losses were on the day. You had you have the non-farm payrolls coming out tomorrow. On Friday, and so that's expected to be 190,000. And the market will certainly start reacting to things like the ADP number tomorrow. That will give a little bit of a hint of what happens on Friday. I still think we are headed for a period of kind of consolidation. Market was overbought heading into the month of April, and we've gone through this pullback consolidation period. Nothing that's breaking any major trends, just like I said, a choppy period overall. And you get those, especially after a big run like we saw from the fall lows into this early spring. And that is not uncommon to get a period of chop sideways and like I said, consolidation. That's kind of where we're at right now. But the big number on Friday will be the jobs number, and we'll get a lot more color on what's happening there then. Now let's keep things moving and swing back to the InvestTalk voice bank for this question that came in earlier.
Good afternoon, InvestTalk. I got a question about Rio Tinto. I was considering closing out of another material position I have in my portfolio to purchase this. Technically, it's like it's had a small pullback, but could be a good time to buy, assuming that your guys' fundamental analysis agrees with mine, which is that I thought it looked pretty good, at least moving forward in the near term with the prices of copper. I know it does other materials outside of copper, and so that's why I was looking to get your take on those as far as, you know, the iron and aluminum and other minerals they mine, and the percent breakdown of revenue and, you know, maybe countries that they operate in, just to kind of give me a better understanding and let me know if this could be a potentially good idea to shift money from where it's at now to Rio Tinto. I'll listen on the podcast. Thanks, guys.
All right, looking at Rio Tinto, and this is a globally diversified mining company. And this has certainly been underperforming the broader materials sector. And that is for one main reason, is that I know you talked about copper, and they do have some exposure to copper, but their main source of revenue comes from their from iron ore. And it's diversified, and sometimes diversity is good, but frankly, in this business, diversity is not so good. Metal products make up about 18%, but metal ore makes up about 85% of their business. Okay. So the vast majority of their revenue, once again, comes from iron ore. Yeah, they have some exposure to copper, aluminum, diamonds, gold, some industrial minerals as well. But this is, at its heart, an iron ore producer. And so if you're looking for exposure to copper, you probably want to look elsewhere. And there's a reason that they have been trying to buy, what was the other name? They were trying to buy another commodity producer. It was BHP. There we go. And, you know, I just don't think that, and I think they rebuffed their takeover attempt, right? And I just, yeah, both of those, Rio Tinto and BHP, are just too diversified. That's one thing you have to weigh when you're looking at really any company. Is the diversity smart? Is it good? Does it create some level of advantage to their business? The vertical integration, that's what happens a lot, right? Companies, they vertically integrate. That's what Apple did. They bought, I forgot the name of the chip producer, ST Micro, was it? I think it was. And that helped them produce their own M1, M2 chips. And that vertically integrates the company. And there's efficiency there, because they don't have to pay those extra margins for good quality chips. They get to control them. That helps produce their end product. And that is a positive. That's positively vertically integrated. But not all vertical integration really pays off. And you can argue in this instance, it's not really vertically integrated. It's side by side, because there are mines all over the world. And does operating one mine, a diamond mine, help you produce more in a copper mine or an iron ore mine? Not really. So I don't think this is the place that you want to go for your copper exposure, because it's mainly iron ore exposure. So I hope that helped give you some context, and it's underperforming the broader material space for that reason. Now we're going into a break. I'm here ready to take your calls. Your live calls are good because we can interact and give you more focused answers. And that means you know the number. It's 888-99-CHART.
The big day is coming up fast. Click the link in this video to register for the new InvestTalk Wealth webinar. It's all happening online Tuesday, June 11th at 1 p.m. Pacific Time. You are invited to join KPP Financial's InvestTalk hosts Justin Klein and Luke Guerrero as they reveal the secrets of quality investing. Learn why it's essential to look beyond high dividend yields so you can build a resilient and profitable portfolio. In today's volatile market, quality investing is the key to long-term success. Justin and Luke will provide insights and strategies to help you make informed investment decisions. Reserve your spot now. Click the link in this video to register for the new InvestTalk Wealth webinar.
Now, our main focus point today covers how simple or complex your investment portfolio should be, whether you're in retirement, pre-retirement, or even at a younger age. Now, the most simple answer, more simple portfolio can be broken down into maybe 3 funds in total. Okay, so a broad market U.S. equity ETF, a foreign market ETF index, and then a total bond market portfolio. That's kind of the bare minimum. Right, gives you geographic diversity and asset class diversity. But in an environment that is now different than we've seen in the past, adding to that probably makes more sense. Okay, now the first one that you should probably add is a sleeve on the fixed income side, and that is short-term bonds. Right, a total bond market index right now has a duration risk that is probably too high for an inflationary environment for most people. Okay, so if you look at AG, that's the iShares US Aggregate Bond ETF, that has an effective duration of about 6 years. Okay, so that means if interest rates move up 1% total, then the fund will drop about 6%. Now, that is not a ton of risk, but it's probably a bit higher than what makes sense. So you want to shorten that duration. So diversifying into shorter term bond funds is probably the first way you can broaden out that diversification. And then another would be some sort of TIPS, Treasury Inflation Protected Securities. Also keeping those short terms, but linking the returns to inflation, because while short duration bonds are better in an inflationary environment than long duration bonds, they still don't give you great inflation protection. Okay, because there's still some duration there, and that payout won't be linked if, say, inflation takes off next year. Okay, so that's something to think about on the bond side. Okay, and I continue to implore people to take less duration risk, and if you're going to take any type of risk, more credit risk. Okay, that's typically what outperforms in an inflationary environment, is taking credit risk. Now, on the equity side, or let's say the actual higher risk side of the portfolio, if you just buy a broad-based equity index, you're going to be really huddled into a handful of names, right? The FANG names, the top 10 largest companies in the world that are typically large cap growth, very tech focused. And so if you can broaden that out into something that's more value focused, that's going to give you more diversity. Now, a foreign index fund is going to be more diversified, but I still think for most people, you need to diversify into the value side, as well as down the market cap spectrum. So mid caps, small caps, longer term, small caps perform the best. But from a risk adjusted standpoint, meaning the amount of risk you're taking, the volatility you should expect versus the actual total return you get, mid caps are kind of the sweet spot. Okay. So if you're in a broad based ETF, like a VTI or an S&P index fund, you're not getting very much mid-cap exposure or small-cap exposure. Okay. And then should you be expanding beyond that? I could very well argue some sort of alternatives like, and I'm not talking about alternatives like private equity, because I think those are just more risky bond funds in a way. I'm talking more of commodity-based. I think of gold, silver, materials in general, broad commodity baskets, and even a smattering of Bitcoin. I have no problem with that. A smattering, not a ton, but a smattering. And then if you even want to go into individual stocks, I have no problem with that either. Sometimes it's not all or nothing. If you have the skill to analyze individual companies, find quality businesses that you think have durability because of the quality of their business, not because of some narrative or because they did well last year or something like that. But hey, this is a business that has a wide economic moat, has high profitability, good balance sheet, good leadership, etc. All the things that we're going to talk about on our webinar coming up on a week from today, right? June 11th. And that can help give you broad diversity, and it helps with tax considerations. When you have more holdings and you're not just in a balanced fund, for example, you can do things like tax loss selling in taxable accounts. That's something that most people don't, they underappreciate about having more than just a handful of positions. And when you diversify across different asset classes, it also allows you in retirement to withdraw opportunistically. For example, in 2022, you probably pull from your short-term bond funds and leave your equities and bonds, the same, because both were down big in 2022. But in 2023, what did well? Well, large cap growth. And so that's a time where you pluck from large cap growth to fund your retirement. So having that diversity gives you options in retirement. Now we're heading into a break. I'm Justin Klein, ready to take your calls live at 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Hi, Justin. Honestly, I'm getting a little bit of FOMO on two companies. I was hoping you can take a quick look at them. I believe you had used to own one of them, or maybe still do. It's SFM, Sprouts Farmers Market, and Sterling Infrastructure, STRL. If you can just take a quick look, let me know that, I don't know, right now is not a good time to buy because I do have FOMO. That'd be great. Thank you. Bye.
Good to admit to yourself that you have FOMO because that's recognizing that you are starting to think about taking action with emotion, and that's what you want to avoid, right? It's not, and that's a very common theme. It's FOMO is just simply another term for greed, right? Fear and greed. That is what typically drives emotional decision making, and nobody has FOMO when the stock is going down. Right, they only have FOMO when the stock is going up, and that is just another term for greed. Now, we own Sprouts. You talked about Sprouts Farmers Market, and we don't own Sterling Infrastructure. Two very different companies. Right, Sprouts is doing well because of good secular tailwinds, people wanting fresher foods. They're also growing their store count, and now that Amazon bought Whole Foods. Sprouts is kind of the up and coming Whole Foods. A lot of people who shop at Whole Foods thinks that Amazon has taken the real health focus out of the store, whereas Sprouts is very health focused. We've owned Sprouts for a long time. We've continued to kind of trim it slightly, and have trimmed it recently. But on any reasonable pullback, I think it is a name to potentially buy. Now Sterling, very different, about half the size, but it's focused on providing e-infrastructure, building construction, transportation solutions, etc. I believe they're doing well because of the building of data centers, if I'm remembering correctly. Their revenue growth has slowed, but their profit growth continues to expand. So, but this is reversed pretty nicely, and you're starting to see this momentum fade. So I would just be patient. If Sterling gets back to around $90 per share, I think that's a good buy point. As for Sprouts, let me give you a number there. Back down around 65, that would be a place that I would pick up Sprouts. That's 78 now. Let's go talk to Jason in Illinois. He wants to talk about tax loss selling.
Hi, Justin. Thanks for taking my call.
Of course.
My question is, do you have to completely sell a stock, or can you sell partial stock to take a tax loss on something you may be down on?
Oh, yeah, you can always take partial. You don't have to sell all of it. Now, if you bought multiple lots, you have to make sure that your brokerage settings are so that you're actually selling a specific lot that you want, because there are defaults.
Okay.
It's usually first in, first out, but you can change that, meaning the first time you bought it, right? Because you might have bought 100 shares and you bought 25 shares 4 different times. You have a total of 100 shares. If you sell 25, which lot are you actually selling? So you might have a gain on one and a loss on another. So you want to make sure that if you're selling partial, that the lot that you're selling is the correct one, and you need to talk to your broker on that.
Okay, thank you very much. I appreciate it.
No problem. So talk to Mark in San Diego. Let's talk about the energy sector.
Yeah, I got a bunch of the big Vanguard ETFs and energy and oil. And, of course, they peaked out a couple of weeks ago, and I'm wondering if it's time to sell some calls on them as they slowly start to retract over the summer.
Well, it depends on your view of where oil prices are going. Now, what's interesting is that after the earnings season, the most revised positively sector in the market was the energy sector, meaning the movement in Q2 earnings expectations moved up the most in the energy sector out of all 11 sectors in the market. So the earnings picture is actually improving, but obviously near term, the oil prices have come down. From looking at the XLE, this is just pulled back to the 100-day moving average. It was overbought going into early April, and this is a fairly healthy pullback, actually into some support today. So, do you sell calls? I rather sell calls when things are overbought, not oversold.
Right. That's my question. Yeah.
Yeah, and right now it's oversold, so I wouldn't be quick to be selling calls in that environment.
Yeah. All right.
Okay.
Thank you very much.
No problem. Thanks for the call, Mark. Now let's talk about the consumer. And there have been some recent indications that the consumer is slowing down, and that is starting to be reflected in GDP expectations for Q2. Now, the Atlanta Fed has a GDP Now tracker estimate that they have a calculation based on different economic numbers that come in. And about a month ago, you had estimates of about a little over 4% GDP for the second quarter. Now, that was early on in the second quarter. Now we're getting to the end of the second quarter, and that has come down about 1.5%. And now the expectation for Q2 GDP is around 2.5%. Now, it's still up from where were we at 1.3 for the first quarter. So it's an acceleration, but at a lower level than was expected just a month ago. And a big part of that has to do with real personal consumption expenditures, PCE, that has fallen from 3.4 to 2.6%. And this is based on last Friday's PCE report. Personal income and outlays by the Bureau of Economic Analysis showed real disposable income falling below zero on a month-over-month basis. And the biggest driver was a significant drop in spending on goods, but service spending also declined as well. So the slowing trend in disposable income usually is driven by slower wage growth, and that should lead to lower consumer spending as well. But is it slowing dramatically, right? Slowing is just slowing. Slowing doesn't mean that things are falling off a cliff. These numbers move around and they gyrate. It's not always a flat number. It rarely is a flat number, especially if you're looking over multiple months, multiple quarters. And this slowdown in the PCE isn't reflected in what the actual earnings calls are sounding like from these companies. Walmart's a good example. They were fairly upbeat. Dollar General did see same-store sales pick up, and you could say, well, consumers are trading down to these stores, but they don't see this as a different behavior. They didn't see behaviors actually changing much from Q1 into Q2. But what's interesting here is that the PCE number has observed as well as imputed numbers. And if you filter out for the imputed number, what you'll see is that there was a bump in the first quarter in the PCE number, but that all was because of what we call imputed numbers. And that is, once again, it's almost guessed in a way from economic activity and numbers that they're looking at, and not actually market-based prices, transactions, etc. And what it shows is that last summer, nominal PCE growth stair-step down from about 6 or 7, 8% through 2022 and in early 2023, down to about 4%. And it's flatlined since then. So while consumer spending has slowed from the beginning of last year, it's actually kind of flatlining around modest growth. So just be cognizant that, and this is exactly why you have to look at a smattering of numbers. You can't point to one economic number and say things are great or things are terrible. Just like you can't look at a stock and say, oh, their dividend yield is this, or their P ratio is this, and that's why you want to buy it, right? It's the entire picture that you're looking at. And everybody wants to simplify their economic analysis down to one number, their stock analysis down to one particular thing, but it's just simply not that simple. But I wanted to highlight that because you might see that number and you might think that things are going to hell in a handbasket. But if you look at the jobs numbers, they had a similar stair step down, or in the continuing jobless claims number, a stair step up last fall. And we've basically been flatlining since then. We haven't been broken out to the upside in jobless claims or continuing jobless claims, or to the downside. So it's kind of steady state for now. And we'll see, we'll get more color on that as we get into the end of the week. Now, if you listened to yesterday's podcast, you know that we devoted it to our dear friend, Steve Peasley. And in case you haven't heard, last week, Steve lost his battle with cancer. We all miss him. And overnight, we got several calls from listeners who commented on Steve. So let's play one of those now.
Hey, this is James from Georgia. I just wanted to call and I just wanted to send my condolences to the family and to you guys as well, and the loss of Steve. And like I say, Steve was the guy, and Justin, you too. I never listened to any kind of InvestTalk show or anything like that. You guys just sucked me right in. When I started listening first time, I've been listening since we had the pandemic breakout was when I got interested. And yeah, man, real sad to hear that Steve passed. But, you know, we're all set to expire one day. Like I say, very, very grateful for all the information that he shared with everyone. And I'm very grateful to you and to Luke. And I look forward to continuing to learn, listening to your show. And Justin, you just did a magnificent job with that show, man. I don't know how you did it, but great job, buddy. And keep on keeping on. Steve, you are in my prayers. I'll be praying for your repose.
Well, thank you for that. I did get some great feedback on yesterday's show, and I appreciate all those that reached out and gave their thanks. And thank you for that call. Yeah, we'll miss Steve. And I'll give you a little nugget of something he told me 6 to 9 months ago, I want to say. And you know, I was visiting him. We were having some conversations, and you know, one thing he said to me is that he wishes he enjoyed his life a little bit more, and said don't wait until retirement to enjoy your life. And not that he wanted to do more. Let's just say in retirement. And so for everyone out there, you know, we talk about being financially aware and conscious and saving consistently, but also enjoying your life, your passions, your friends, your family. It's also very, very important as well. So make sure you have that balance. I know I try to find that balance at all times. Steve was one as well. So just wanted to give you that advice that he gave me, you know, in his final year. Now, I hope you've been telling your friends that our InvestTalk audio podcast is also available over on our YouTube channel. And it seems that every day now we receive finance and investment questions from the comment section of the InvestTalk YouTube channel. So here's one that came in recently. Ryan Ketza says, looking at adding more exposure to energy companies. Can you do a comparison for Suncor and Cenovus? So Suncor, and that is, I believe that is SUN. Yep. That's SU, excuse me. That's SU, Suncor Energy. And that's a Canadian oil and gas explorer, refining and marketing of oil sands in Canada. If I'm remembering correctly, let me pull this up here. That Suncor also has a utility component to them. Oil sands, I'm trying to remember if any marketing. Oh, maybe they don't. Maybe I'm thinking of a different name. No, they do. Yeah. It develops petroleum resources. Okay. Let's just say I've looked at both. I've looked at many of these names. It's been a while since I've looked at Suncor, but we recently purchased a Canadian oil name. And I'll say this, that it was between that one and Cenovus. Suncor didn't make it near the top of the list. So Cenovus didn't quite make it to the very top, but it was second. So if I'm picking one or the other, Cenovus would be the one. It is a pure play Canadian oil E&P company and refining. They have the refining capacity here in the United States as well. So I'd pick CVE over Suncor. That was Cenovus. Now, this is InvestTalk. I'm Justin Klein. We have one goal here each and every weekday, and that's help you achieve your own version of financial freedom. And work continues after this final break. So get your questions in now at 888-99-CHART.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Hi, InvestTalk guys. This is Kevin calling from La Crescenta, calling about the Toro company, TTC. I had an alert set at 78.2. It's reached that, and I'm just wondering, you think it's still a good buy? I know you think it's a good company, and I'm just wondering if you think it's going to hold these levels, if it's a good buy at this price. I appreciate your advice as always. Thank you.
All right, looking at the Toro company, and they manufacture turf maintenance and landscaping equipment. And this is one of the best in this particular niche. Best company, best operating margins, about 12%, return on equity 19%, and it's a very quality business. Now that profitability has come down some. Its 5-year average of return on equity is around 32. So the big question is, can they bring their profitability back up? Pre-pandemic in 2018, their return on equity is 43%. So, that profitability has been cut in half, and I would worry a bit that it's going to stay down there. If it does, then, this multiple is probably about right, and I would say it's fairly valued. If it can get its profitability back up into, say, the 30s, return on equity in the 30s, then I think the multiple should expand back into the high 20s. Right now, it's around 20. And they do have a good balance sheet. Free cash flow is $144 million. Not as high as I would like it to be. Let's just be frank. So there's some work I think that still needs to be done on the business. Growth has flatlined in 2022. They made $4.20. This year, they're supposed to only make $4.26. So they need to return to some level of growth. And, there needs to be some improvement on the profitability front. So there's some risk here, but it is at a pretty good support level around this in the $75 to $80 range. We're at $79.31 at the close today. So be aware there's some risk there, but longer term profitability tends to mean revert, and they're in the low end of that long-term profitability range. And therefore, I do think it is a fairly good risk versus reward at the current time. Now, let's talk as we close about the boomer generation. And it's really interesting because there are about 270 million boomers across the rich world, and they make up about 20%, or at least in America, they make up about 20% of the population, while boomers have about 52% of the total net wealth, 52%. But they are very stingy. They're not spending it. And economists are really trying to figure out why that is. Now, there's a few basic explanations. One is that they are worried about long-term care, okay, and longevity risk, right? Many boomers will live to 100 and beyond, meaning that they'll spend, a third of their lives in retirement. Now, the share of Americans that are very confident they will have enough money in retirement has fallen from 40% in the mid-2000s to less than 30% today. And on top of that, many of them are scarred from the pandemic. In 2022, American boomers spent 18% less in real terms on dining out than in 2019. And we all know, the retirees, that's a big part of their, excess spending beyond the basics is, going out to dinner with their loved ones, with their spouse, with their friends. And that's happening nearly 20% less than it was before. So they're buying fewer experiences and they're accumulating wealth almost by accident. So in many ways, when you have 52% of the wealth and you're not really spending more, a lot of them are still saving, their net income. That is really keeping the growth of the economy relatively slow. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can get anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And remember, our next InvestTalk Wealth webinar is coming up fast. It's 1 week from today on June 11th. And you can learn more and register now at investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.